In this video, we will see what are options and how they work. This understanding is the core of understanding options. Once you understand this well, everything else will start coming together intuitively. So what are options? Now the wiki definition here can be a little complicated. An easier way to think of options is to think of them as a financial product derived from another financial product like a stock or index. It carries a risk premium for the risk associated with it. The buyer buys the risk cover and pays a premium, and the seller sells that risk cover and receives a premium. So, if you think about this carefully, it is just like an insurance policy. In insurance, a buyer of insurance buys a risk cover for a premium, and the seller of insurance, that is an insurance company, sells that risk cover and charges a premium. So, if this helps you in understanding options more intuitively, it's perfectly alright. Now, there are two kinds of options: call options and put options. And very simply put, call options are options that gain in value when the price of the underlying goes up. Remember, it is based on an underlying. And similarly, put options are options that gain in value when the price falls. So they are inverse to each other. So as a buyer, call options represent bullish stance and put options represent a bearish stance. Now let's look at the profit and loss profile of an option. So let's take a call option. Notice here we have something called a strike price. Now think of strike price, and this is where you see a strike price represented by the orange dashed line. Now think of strike price as a boundary line of profit and loss of an option. The buyer will lose the entire premium if the price remains below the strike price, and consequently the seller will gain this premium which the buyer just lost as their counterparties in the same trade. We will later cover as to how do we go about selecting the strike price, but for now let's just focus on understanding how the profit and loss scenario plays out. So here we have taken a Nifty contract. A Nifty is an Indian stock market index. So we have taken a Nifty contract at a strike price of 10,650 here and at a premium of 50. So if I'm a buyer, I will make gain on this option after Nifty goes past 10,650. After Nifty exceeds 10,650, I start making gain on this option. However, my net profit will be the difference between the gain I make on this option less the cost I paid to purchase it. So at 10,700, I'm making a gain of 50 on this option. But since I paid a premium of 50 bucks to purchase this option, my net profit and loss is 0, which is my break-even point here. And thereafter, my profit and loss as a buyer is linear, which means that for every unit increase in price of Nifty after 10,700, my profit will also increase by 1 unit. That is this range. Now let's consider for a put option. Again, we take Nifty at a strike price of 10,650, which is here, and a premium of 50. Remember, put options gain in value when the price falls below the strike price. So this option will start making profit when the price falls below the strike price, which is from here. But as a buyer of this put option, I've also paid a premium of 50 to purchase. So I will start making gain when the price of Nifty falls below 10,650. And at 10,600, I will have a break-even point because on this option I'm making 50, but I've also paid 50 to purchase this option. So at 10,600 will be my break-even point, after which my gains will be linear, which is this entire range here. And consequently for the seller, this entire range, or rather from this point onwards, after the break-even points, the seller will be making linear losses. Whereas if the price were to remain, or if this contract expires above the break-even point, the seller will not lose any money, and if the price remains above 10,650, the seller will pocket the entire premium, and the seller does not lose any money till 10,600. So a buyer will make profit net profit on this contract only if the price were to fall below the break-even point. Now the profit and loss profile of a buyer and seller are exactly the opposite. What one loses, the other gains. So in a call option, a buyer will be making indefinite profit after the price were to go past 10,700, which is a break-even point, which will be the loss of the seller. And in the same call option, a seller would be pocketing the entire premium if the price were to remain below the strike price, which is 10,650. So their profit and loss is exactly the opposite. And in a put option, a buyer will be making profit, net profit on this trade, only if the price were to fall below the break-even point, which in this case is 10,600. Whereas a seller will not be losing any money if the price were to remain above or up to 10,600. So their profit and loss profile is exactly inverse of each other. Now you will notice one thing here, that for a buyer, the maximum loss or the maximum risk in this trade gets maxed out up to the extent of the premium paid for the purchase of the option. Whereas the gains can be unlimited. Whereas for a seller, it's exactly the opposite. The losses can be unlimited, but the gains will be limited to the extent of the premium collected. And same in the case of put option. Now, if this were the case, that a buyer can make indefinite gains but limited losses, whereas a seller can make indefinite losses but only limited gains, why would anybody sell an option versus buy an option? Okay, we'll get into the merit of buying versus selling an option a little later, but right now what is really important is to understand the profit and loss profile of these options, both for call option as well as a put option. And the best way to do this would be to just play around with various price scenarios during expiry in an Excel sheet. Alright, so here I've populated an Excel scenario for a call option and a put option. So the contract here is Nifty. The type of option is a call option. This is a strike price and this is the premium for this option. Here you see the various spot price scenarios which can occur at the time of expiry of this contract. Now this is a call option. So an important thing to note here is how do we calculate the profitability. So the profitability will be a maximum of 0 and the difference between the spot price and the strike price. So we know that this option, a call option, makes money only when the spot price exceeds the strike price. So at this point, the spot price 10,400 is below the strike price, so the option will not be making any profit. And when an option is not making any money, the total money value of that option is 0. And the way to calculate profitability for this is, I take the profitability on my option, which is here, and then I deduct the premium which I paid. So here I paid a premium of 50, I'm making a profit of 0, so it will be 0 minus 50, and this is my net P&L. And then I can populate it all across here. So you will notice that as a buyer of this call option, I am losing the entire premium all the way up to the strike price, which is 10,650. And at 10,700, I achieve a break even. And after 10,700, I start making money. And the profitability of a seller will be exactly the opposite. So we know that the profitability of a seller is the profitability of a buyer into minus 1 and vice versa. So as a seller of this call option, this entire scenario right from here to here is a favorable scenario where I will not be losing any money. And from 10,650, any price which is below 10,650 and up to 10,650, as a seller of this call option, I will be pocketing this entire premium. And for a put option, this is the entire spot price scenario, same as above. The strike price remains the same. Now instead of a call option, we have taken a put option. This is the strike price. This is the premium, which is the same. Now the profitability of a put option will be the maximum of 0 and the difference between the strike price and the spot price. This is because we know that a put option actually gains value or gets in the money or starts making profit only when the spot price falls below the strike price. So an option, a put option, can either be making a profit of zero. The lowest profit that it can make is a profit of zero, where it is not making any profit, and above. So here, the spot price is 10,400, which is lower than the strike price. So this option is gaining 250 bucks. But I also paid 50 bucks as a buyer of this put option. So my net profitability will be 200 bucks. And likewise, so I populate this all across. And as a buyer of this put option, you will notice that I'm making money once I achieve a break even at 10,600. At 10,600, my profitability is zero. But thereafter, any price scenario below 10,600, I'm making money as a buyer of this option. And conversely, as a seller of this put option, I will be losing money if the price were to fall below 10,600. However, if the price were to remain above 10,600, the buyer will be losing this entire premium and I will be pocketing this entire premium as my profit as the seller of this put option. So it's fairly straightforward, but if you're new to options, I would encourage that you populate a few of these Excel price scenarios yourself. You can take hypothetical prices, that is not very important right now. You can take hypothetical spot price scenario, you can take hypothetical strike price and premium scenarios. What is important is for you to get a hang of understanding the profit profile of a call option and a put option, both from the point of view of a buyer as well as a seller. And study these formulas of profitability for a call option and put option a little more carefully. And the more you think about it and the more you apply in various Excel simulations, you will start getting a hang of this intuitively.